Coming up today, stocks continue to climb, new meme stocks light up, home builders rip higher, big tech earnings on deck, the huge growth in Darkpools, calls for power to resign grow, and massive short squeezes are happening right now after hours as I speak. You don't want to miss this one, guys. Let's go. And welcome back, guys. And once again, the market proves to us all there is nothing more entertaining than the US stock market. We've got some big stuff happening under the hood right now as I speak that we can't see here on this heat map of large cap and mega cap tech stocks. With the chip stocks actually coming off a bit today, and we get to hear from Tesla and Alphabet Google and their earnings tomorrow after close. And even though the S&P 500 finished flat on the day, we actually got some big moves. Healthcare bouncing up off lows, along with REITs and home builders. Some of them having some huge moves today, and Wall Street's not really sure why. This is a real article in the Wall Street Journal from today titled, "Why Are Stocks Up? Nobody Knows." But that's the thing, it doesn't have to be a logical reason. Stocks don't need a positive headline in order to rally. All they need is more people to buy them than sell them. More bids than offers. That's what causes prices to go up. And that's happening in a big way underneath the surface in small stocks, so-called meme stocks, retail favorites. The latest today, Coles, ripping up over 37% on the back of no news, as we once again see the collective power of retail investors looking to overwhelm stocks that have high short interest, typically from hedge funds that have sold the shares short, betting that the price will go lower, with one analyst labeling it a flight to crap, as they once again label us dumb money, flocking to risky companies with little to no profitability. And there's a look at KSS, which ripped up there today, but we're getting a whole bunch of action in old favorites. GoPro, which had been absolutely trashed the last couple of years, up 41% today and still ripping after hours, another 43%. Similar story for Krispy Kreme, ticker symbol Donut, up 26% in the regular session and still ripping after hours, another 26%. Faraday Future Intelligent Electric EV company, also having a big move on monster volume today, just like we've seen in many small stocks with high levels of short interest, percent of the float that is held short. In other words, small stocks that many are betting against and want the stock prices to go lower have had great days and are still ripping after hours as I speak. And just looking at a few on the chart, Neo Volta is one of many stocks pushing up after hours here, as is 1-800-Flowers.com. Big moves happening in the post-market session. Same with Rich Tech Robotics, another heavily shorted stock. Retailer Children's Place, Beyond Meat, and so on. The list goes on. We're getting some big-time action in today's regular session that's accelerating right now as I speak, even though, like I said, the S&P 500 pretty much finished right on flat. And in fact, we actually saw the Mag 7 and the NASDAQ 100 index come off a little bit, but a bit of broadening in the market. S&P 500 equal weight up 1.2%, and mid-caps, similar story as well. Just as we head into the thick of earnings season, mega cap tech up on deck. And we still appear to be following a similar price analog of the mid-late 90s. And just like now, there was also concerns back then over valuations and other things. The Asian financial crisis, a massive hedge fund blowing up thanks to Russia defaulting on its debt. But it shook all those things off until it eventually reached a blow-off peak in March 2000. And the fact is, it's not just mega cap tech and meme stocks. We've got a global equity bull market that's actually broadened out and strengthened this year. Many indices that have done nothing for a decade or two have actually climbed to new highs. And we've now got more than 80% of all countries above their 200-day moving average. And you could kind of think of that as like a massive rising tide. Very hard to go against for those that are trying to time the top. But that doesn't mean there can't be discounts to be had. Small caps still at some of the cheapest valuations relative to large cap. Plenty of healthy stocks out there still on a PE of 15 or lower. And if this cycle plays out like price cycles, could suggest that small caps are about to outperform large caps, potentially 5 or 10 years going forward. And this is another reason I've been betting on a catch up with small caps, because we're currently on a record number of days since the small cap Russell 2000 index has reached an all-time high, given the S&P 500 is pretty much sitting there now. And there's a look at the weekly S&P 500 chart, which does look a little different from the Russell 2000. I think there's plenty of room for it to catch up here. Valuations are much better, and political moves should also favor these small caps too. But it's not just small caps. Defensive companies have also been heavily sold off relative to the market. Looking at a composite of healthcare, utilities, and staple stocks, as a percentage of the S&P 500, down near 25-year lows that we saw back in the late 90s. But that doesn't mean it's a hard floor. There are no limits in the market. This could very well be on a path to 10% over the next 5 years. Nobody knows for sure. This just helps us visualize the context that the market is currently in. But it's by no means the sole reason to go out and pile into defensive stock. And out of that defensive group, the cheapest in absolute and relative terms is healthcare. Like I told you guys yesterday, it was setting up for a good risk reward entry, coming down to support here. It's had a big bounce there today and could still have further to go. Looking at the leveraged healthcare ETF Cure, may just be defending these mid-May lows, which also saw some buyers come in there. And so there's quite a lot of dispersion out there, which is not all that unusual in a bull market. In fact, rotation is kind of the lifeblood of a bull market. It's typically in bear markets. All stocks act like a school of fish, go down and up together. And so even though the defensive stocks have been weak, and for sure we've got a buzz of activity happening, these smaller stocks, retail favorites, again, doesn't mean it's all about to top out tomorrow. This stuff could go on for months, and who knows, maybe even into a potential epic melt up, the likes none of us have ever seen before, as we're still getting huge growth in 0 day to expiry options. Now, technically, every option eventually ends up as 0 DTE on the day of expiry, but there's been a huge growth in daily options, as typically most options expire on the third Friday of the month. Then they introduced weekly options, about 500 or so stocks expiring every Friday. But then on a select number of indices, we've got daily options, with the most liquid option market being SPX index options, and now 61% of the volume is in 0 DTE option. And in fact, overall, 68% of all volume has been in call options. Traders betting on more upside. In fact, we haven't seen that since the bubbly days of 2020, 2021. But again, just like back then, it can go on for some time. Just because we've hit a record doesn't mean it's going to turn around the next day, just as it can go further and for longer than it did back then. Again, nobody knows for sure. You just got to play the cards in front of you. But we are getting a few little contrarian signals as well. Corporate insiders starting to sell into this strength, as they quite often do. We saw that late last year. But as usual, they bought the dip on the April lows. And so it's not all that unusual to see a little bit of profit taking on the back of this great V-shaped recovery. As we are heading into a typically volatile period when we see volatility rise in Q3. And volatility is super compressed here, not just the VIX index. Pretty much tracking sideways for a couple of months now. Even low as realized volatility. And we can just see my volatility heat map indicator. We're in a very long volatility contraction cycle. But no doubt volatility will light up again. It's inevitable, just a matter of time. With whatever reason or catalyst, we're bound to get it at some point, and would be surprising if we just sail through the rest of the year with no further bumps in the road. And volatility hasn't broken down to lows like the market's broken to new highs. There is a little bit of divergence, so still some hedging going on, but also probably so much call option volumes that could be driving up implied volatilities a little as well. And so the indices have now gone 60 trading days above their 20-day moving average. We're now actually hitting records. But after this winning streak inevitably ends, we can be in for a period of softness and consolidation, if not a healthy pullback, looking back in history. And there is a bit of correlation actually between how long the low volatility streak lasts and the size of the pullback. And that's because when things are so good for so long, it attracts so much hot money, so much leverage, people shorting volatility. Then when it inevitably uncoils, it just creates a bigger uncoiling. But that's not necessarily a bad thing looking out further than a few months. In fact, when the S&P does have more than 60 days above the 20-day MA, future returns are positive, but the average returns aren't that great. In fact, 12 months is only a little bit above what the stock market will do on an average year anyway, 9-10%. And that just shows a lot of the gains have been had, and then the market can somewhat consolidate, but still holds up. And so we very well could be in for a period of consolidation in Q3. But what's also going to play into that is how we go in earnings season. So far, so good. In fact, on some measures, it's actually great. Saw a bunch of home builders rip up really strongly today after they'd been beaten down the last few months. And these are huge moves for these large caps. DR Horton up 17%, Pulte Group up 11%, and in fact, it was the best performing sector today. Home builders ETF up over 5% on really good volume here. And that was likely amplified by news that the administration is looking at removing capital gains tax on home sale in an attempt to juice up the housing market. I think a lot of people underestimate the potential for this administration to really unlock markets. You look at how well American stocks have done over the last 5-10 years. With administrations you could almost call anti-business. Now we've got a pro-business one. Massive changes of deregulation, tax cuts, incentives for domestic production. They've already done $100 billion in tariff revenue. Big companies and sovereign entities all around the world are committing to invest trillions in the States. Yet some people think that's all bearish and create their market views based on the personality of the president. But the numbers don't lie. And once again, we're getting a raft of EPS beats across the board today. And the market is rewarding those beats by more than average. Companies that have reported positive earnings surprises have seen an average price increase of 2.5% 2 days before their earnings release through 2 days after. That is more than double the 5-year average of 1% for the same window. And it shouldn't be a massive surprise because the percent of S&P 500 companies with positive 3-month percent changes in forward revenues, what they're expected to generate in sales going forward is actually breaking out. And what you'll notice going into prior recessions, shaded here in the grey, is that revenue expectations are already decreasing and breaking down going into it. We've actually got the opposite here. But at the index level and looking at Magnificent 7, there is a bit of wait and see, waiting with bated breath. What exactly are the Mag 7 going to deliver us when we get to hear from them starting tomorrow with Alphabet, Google, and Tesla? Next week, Apple, Amazon, and Microsoft. And of course, that has big implications for the AI trade. And Nvidia, my bet is they once again beat by far and large overall, reiterate their capex, and I wouldn't be surprised to see a raft of dividend and share buyback increases as well, which always lights up the algos. And we'll see if that can actually kick off some new trends. Make sure you come back to Click Capital tomorrow and I'll break down for you all the latest numbers on Tesla, which has been coiling up for a few months here, and Alphabet Google, as it's been perking up going into its earnings tomorrow. And how will that affect the entire Mag 7 group, which are a little technically stretched here in the short term, and we do have a bit of bearish seasonality. So could this be a buy the rumor, sell the news event? Well, let's just wait and see what we get tomorrow afternoon. And just moving on to a big part of the market now that we can't ignore, dark pools, which by some measures are actually conducting more volume than the actual exchanges, what they call the lit exchange, the NYSE and NASDAQ, where we can easily see the tape. However, dark pools are required by law to report their trades as well. And for those of you who don't know, dark pools are private exchanges where financial institutions conduct large block trades outside of public markets. And they exist to serve large funds and institutions that need to move large amounts of shares, and it's harder to do so on the lit exchanges because the high frequency algos sniff them out and front run them. And so if you're a hedge fund or an institution, you may call up your Wall Street broker and say, I need to buy $100 million worth of this stock, and they'll shop around on the street for it, line up a bunch of sellers, and then put it all through as one big block trade, for which, like I said, is legally required to be reported. And so a lot of traders out there just rely on dark pool block trade scanners like volumeleaders.com that spit out large prints with no context, for which is pretty much useless. Because yeah, you get more block print at turning points, just like you get more volume in the market anyway at turning points. But these block prints don't tell you who's buying, who's selling, or whether it's bullish or bearish. It's simply just noise that, whilst may be entertaining to look at, it doesn't actually do anything for you. And that's why I don't track block trades, because like I said, you can't tell if it's a buy or a sell. And you're just looking at individual trades. You don't know whether that's a hedge, a pair trade, statistical arbitrage, or even a fund getting out of a trade. It may not even be initiating. Whereas my dark pool percentage indicator, a brand new indicator I've just coded up, does something completely different, and it's much more useful. It's not based on just identifying block order prints, nor is it based on normal price and volume data, like pretty much all other technical indicators are. It tracks off-exchange volumes reported by FINRA, and that's what allows us to read between the lines of market maker behavior. You see, a large chunk of short volume isn't actually bearish positioning. It's actually market makers hedging buy orders they're filling in dark pool. And that's often a signal that big money is stepping in quietly behind the scenes. And so I've accumulated all of that into one daily print, the percentage score, which estimates what percentage of the volume is dark pool buyers collectively. And so it kind of plots this hidden footprint that you won't find in any other technical indicator available on the TradingView platform. Typically, this stuff costs thousands of dollars from proprietary data providers. And so it's simple to understand. When it's green and bigger, that means there's more buyers than sellers. And then when it's red, that suggests that dark pool buyers are not showing up. And it just so happened here on this stock, DraftKings, to give the lowest print right at the top, just like as it showed signs of accumulation this last couple of months. And just to show you some other examples of stocks I'm currently looking at, AppLovin, good chance it could be added to the S&P 500 index this year. We have been seeing some accumulation recently, just like we did back in late April. Oddity Tech as well, getting some signs perk up there. And again, they just so happened to nail the low on this stock, giving us the biggest print that day. We just got a big print today in Hinge Health, 39% dark pool buyers. And another new stock as well, Chime Financial, 50% dark pool buyers today. And I can see my new retail interest index is still shaded grey, meaning retail traders haven't jumped on this one next, meaning there's potential that they could with a new hot fintech like this. And as I noted on my X channel today, Zeta Global Holdings has been getting a lot of dark pool activity, and we can see with the short-term moving average here in the blue line increasing against the long-term moving average, allowing us to easily visualize the trend in dark pool activity. And that's why my two newest indicators give us a look at both retail traders and the so-called smart money. And so if you're interested in seeing what dark pool buyers are doing collectively on every stock and ETF with a total score for each day, and instead of just following block prints, which you don't know if it's a buy or sell, it's pretty much just noise, this indicator is the best to do it. And that's why I'm so excited to launch it, because no one else out there has got this. And so tomorrow I'm making these brand new indicators available, along with a 25% discount coupon code available only for 1 week, allowing you to get these two indicators and 28 of my other custom TradingView indicators as one package. package. And so if you haven't already, subscribe to this channel and make sure you're on my private email list as well. Click the link below this video. Head on over to clickcapital.io, jump on my email list, and you'll be the first to find out when my new indicators are available, along with getting the 25% discount coupon code. I'll also be making available a lifetime option for all of my indicators as well, with no ongoing costs for anybody, including those currently on monthly subscriptions, if you want to upgrade and save going forward, as any new indicators I develop in the future will also be included in your purchase. And so with the new Darkpool and retail interest indicators, that's 30 custom indicators in total I've spent the last 10 years developing that I use exclusively, and so do 500 plus other active traders from all around the world as well. My indicators work on every asset around the world, no matter what you're interested in. So like I said, come back tomorrow and you can get access to these custom unique indicators that nobody else has got. And just moving on to what else traders are talking about today. We just heard respected economist Mohammed Al-Iran saying it's time for J. Powell to go. The normally soft-spoken conservative economist making a bold statement, definitely getting people talking as the pressure continues to grow on J. Powell. And just reading Mohammed's post on this, for which he said he feels very strongly about, said the admin's attacks on Chair Powell are likely to escalate in the days and months ahead. They're not just targeting him personally, but increasingly involving broader aspects of the institution itself. And we heard that from Treasury Secretary Scott Bessent yesterday when he called for an entire review and overhaul of how the Fed operates and looking at their decisions, not just monetary, but in-house as well, including their blown out budget to renovate their own building, $2.5 billion. But Mohammed's also saying this is in the best interests of getting back to an independent Fed, which he thinks is practically impossible with Jay Powell there. And he thinks the best option is for Powell to step down, for which, as you guys know, I already agree with. I've been calling for this recently as well, and hence why I'm actually betting on it in prediction mark. I think there's a good chance, obviously not guaranteed, but a good chance Jay Powell won't be in there come Christmas, which will no doubt cause some sharp volatility if and when we get that headline, as the media will no doubt label it the Fed's lost independence. It's a structural change and how interest rates are set. And no doubt that's partly true. We don't normally see the president attack the Fed chair, but also I think part of it is Jay Powell's own doing a massive rate cut right in front of the election when inflation was materially higher and the labor market materially stronger. And that's on top of printing more money than any other human being or entity has done in the entire history of financial markets, on an inflation adjusted level as well. Again, he doesn't want to talk about that, not to mention other issues with house dealing over the years amongst his team as well. But if he were to do it right now, it wouldn't be ideal because we're still on the cusp of trying to get some trade deals across the line. We've already got the framework in there with China, the big one, and a signed deal with the UK, but the European Union is still on deck, and next Friday is the 1st of August, which the market doesn't seem to care about at all. Looking at volatility pricing, acting like it's a done deal, but we do see a very flexible administration that's willing to adapt and change as required. And like I said, with markets at all-time highs and the VIX at 16, they're in a position of strength to negotiate, unlike early April. And relations are thawing with China. We saw them last week allow Nvidia to sell the H20 chips to China, and we're getting positive rhetoric from both sides. And I think that's why Chinese securities as a whole quietly broke out to new multi-year highs today. Not really being discussed out there, but that's what happened in FXI, and a whole bunch of other charts looking good as well. Chinese internet shares perking up, and the Hong Kong ETF also breaking out on strong volume here, and another good technical sign. And we're also getting reports that Trump may actually meet with Xi Jinping for the first time in a while. No doubt that will cool markets, as I think that was a big sticking point for markets. In fact, on that surprise news that the Chinese and Americans were able to hash out a deal in Geneva on the 11th of May, the S&P popped up above the 200-day moving average, came back for a quick retest, but has stayed above it the whole time. That's what gave us that gap US-China trade deal. But let's just see what we get in the next week. We may get a last-minute deal with Europe. Otherwise, how's the market going to digest 30% tariffs on European Union goods coming into the States? Because again, looking at the Euro Stocks 50 index, which is kind of the S&P for Europe, it's pulled back a little, but still holding up there. And the euro currency acting like there's a deal already done, whilst it's still the US dollar continually under pressure here, along with a little bit of a pullback in yields this week. Got the 10-year back below its 200-day at 434. And just wrapping up with a look at a few other key markets, Ethereum now consolidating for the last 3-4 days, just above 3,700 a coin, and just below prior resistance from December last year. A little bit of bearish seasonality here in the short term. We'll see whether we can get a little pullback. I suspect any dips will get snapped up. And just looking at gold, maybe looking to break out of this triangle formation it's been on for a few months now. Platinum's still in a parabolic uptrend. Crude's still coiling up, and natty gas as well, just coming down to support. But again, I think the biggest thing from today is the short squeeze in these small, highly shorted stocks. I'll be paying attention to them tomorrow. See if we get any follow through. what could be next to catch up as retail traders are well and alive as we're right on the cusp of mega cap tech earning. That's all for today. Thanks very much for tuning in, and make sure you come back to Click Capital tomorrow. I'll break down the latest numbers and market reaction to Tesla and Alphabet Google earnings, all the other hot stocks out there, and how you can get my retail interest index and Darkpool percentage indicator with a 25% discount. And just like myself, I think you'll find these tools really valuable for your trading as well. That's all for now. I'll see you back here again this time tomorrow. Cheers.